Hello everyone. This video is going to provide a quick walkthrough on chapter 18, non-liquidation distribution. Before we get into the details, let's take a look. What is corporate distributions? What's the underlying transaction? Whenever we talk about distributions in this context, really we're talking about transfer value. The transferor, is transfer value to the shareholders. Really, the value here is a very, very broad concept to shareholders. Anything with economic value, right? So the common value of transfer, including the cash dividend or a stock dividend, this is something you are more familiar with. In other instances, for asset reallocation purposes, sometimes the shareholder may want to retain ownership of certain properties. They're just moving the properties from corporate to the shareholders. In this case, there could be a distribution from the corporation to the shareholders in terms of property. This property can be tangible property, intangible property, any non-cash property. And finally, there are some other transactions could be a little bit more complicated than just a simple cash dividend or stock dividend or a property distribution. This could be a share repurchase. So basically, the corporation is purchase the shares back from the shareholders and then pay cash to the shareholders um, in exchange for those shares. So again, this is another form of corporate distributions. The other thing we mentioned in the chapter is regarding this constructive dividends. The constructive dividends represents the unreasonable excessive payments uh, paid from the corporation to the employees, slash shareholders. So in this case, this could be still it's the initial transaction is the corporation is a transfer some value to the shareholders, for some reasons. In this case, it's for reasonable payments for services, in the form of salary or loans. Maybe the business decide to give zero interest loans to the shareholders, or use of property to the shareholders, for a small amount of rent. So in this case, the IRS we're going to look at is they're going to look through this transaction and see whether there is any unreasonable or excessive payments uh, from the business to the shareholders. So any unreasonable or excessive amount will be characterized as a constructive dividends to shareholders. In other words, it is treated as in a form of distribution, because in a sense, really, the purpose of the transaction is not within the normal course of business. They're just making a reasonable payments to the shareholders as employees. Rather, they're just doing this transaction to facilitate the corporate distributions. Okay, once we understand what is a non-liquidation distribution is about, understand the different forms of the distribution, and who the transferor and who the transferee. And now when we look at this knowledge map, or all the different topics covered in this chapter, I think things will start making a little bit more sense, right? So the non-liquidation distribution covers, really kind of this primary uh, form is a normal cash distribution, or combined with a non-cash property distribution. So this in terms of land or building or warehouse. Uh, so those distributions, and of course, The other form could be stock dividend, because in this case, they're just basically give more dividends, more stocks to the shareholders in the form of additional stock, right? When they send out, when they give out the stocks to shareholders, in reality, there's no economic value truly realized at this point, because unless the shareholders sell the stock, uh, you know, then whatever the stock dividend, really, there's no tax consequences, because that's why it's, generally speaking, it's not taxable. And for stock redemption, it's going to be very, very complicated, because the share repurchase arrangement, and because the shareholder, in a sense, they're basically selling their shares back to the corporation. So in a sense, there could be two possible treatments. Once we're looking through the transactions, there could be a treated as exchange. Um, in a sense, the shareholder is selling the stock for a value, right? Treated as exchange. So you have to figure out the capital gain loss, all that. And the other treatment could be the stock redemptions could be treated as a dividend, a distribution. So depending on which scenario they fall into, the treatment will be different. But if the stock redemption is treated as a dividend, then the ordering of distribution allocation will also apply, uh, just like regular cash or non-cash property distributions. Finally, the chapter talks about the partial liquidation. For the partial liquidation, generally speaking, those transactions will be treated as exchange. Uh, and again, the focus of this chapter is really on this first, like the normal cash or property distributions, and stock dividend, stock redemptions, and partial liquidation. All those are very complicated advanced topics, which for you, it's just for you to read and have a basic understanding what it's about. And really, there's no calculation uh, required for those topics. So again, let's move back to the regular cash or non-cash property distribution. Really, the key here is, how do we characterize this distribution? What is the ordering of the distribution allocation? In the context of the recharacterization of this distribution allocation, the earnings and profits, this concept is introduced because earnings and the profits are a reflection of economic income. So basically, the later on, some of the additional adjustments and non-cash deductions and tax-exempt income, some of the adjustment, get back to make sure the earnings and profits is more closer to economic income, for the sole purpose of determining whether the distribution is characterized as a dividend, a return basis, or capital gain. To sum up, really, when you read the chapter, really the key is right here. So you want to truly understand the cash, non-cash property distribution, how to characterize the distribution, all that, and how the earnings and profits are determined. The earnings and profits determination is something you can quickly scan through. uh, you just want kind of quickly understand what type of adjustments going in. But for calculation purposes, really, we're not going to get into a full-blown calculation on the earnings and profits. A lot of times, the question given in the scenario, the earnings and profits are already given. Really, the focus is the characterization of the distribution allocation. Those rules will apply, no matter whether you're in the stock redemptions or partial liquidations, as long as treated as a normal distribution, those similar uh, ordering of distribution allocation will apply. So again, the key is really right here. Earning and profits is something just for your reading and for your information. Okay, so dividend determination use earnings profits. Again, we're getting back to the distribution, allocation, or characterization. So what is the dividend? The dividend for tax purposes could be different from financial accounting purposes. This represents any distribution of property made by a corporation to its shareholders out of its earnings and profits. Again, this ties back to this concept here, right? Whenever there's a distribution, we're using the earning and the profits as like a benchmark to help determine the characteristics of the distribution. And for that purpose, there's two separate earning and profits accounts are maintained, and they're maintained as a separate pool or separate accounts. So the current earnings and profits determined on the last day of the year and accumulated earnings and profits. Uh, this is undistributed earnings and profits from prior year. And the E&P can be negative or deficit due to entity losses, not through distributions. So in that sense, you will see the earnings profits is very similar to the concept of retained earnings. The only difference is for earning and profits purposes, they're functioning under a different set of rules, but there are still a lot of similarities, and it just there's a couple adjustments you had to do to convert from it convert the taxable income to earning and profits. Plus, when you read through the adjustments details, you'll realize a lot of the book tax adjustments are reversed. When you try to identify the difference between the taxable income and earning the profits. So they really kind of cancel each other out. So at the end of the day, the E&P amount a lot of times are actually close to the book income. So in practice, a lot of the corporations, they just simply use their net income, GAAP income, um, make it equal to the earning and the profits. If they're not dealing with very, very complicated transactions. Okay, what is the ordering of distribution allocation and what is the tax implications for the shareholder as well as the corporation? Okay, the corporation is the transferor, so they the corporation is the party which initiates this transaction. For tax purposes, any distribution is not deductible. It's not deductible. And this ties to the double taxation concept for corporations, and their earnings will be taxed at the corporation level, and any distribution will be taxed at a shareholder level. And those earnings, which is already taxed at the corporation level, will be taxed again at the shareholder level. So that's where the double taxation kicks in. And in this case, again, whenever the corporation is making a distribution, there's no deduction for tax purposes for a corporation. However, the distribution will reduce the balance of earning and profits pools. Uh, so in this case, from the corporation perspective, it's pretty straightforward. Then now let's take a look the effect on the shareholder basis. The shareholder basis, there's this ordering of the distribution allocation. Start with current year E&P, and then next later on to the accumulated E&P, and third we're going to look at the stock basis, and fourth we're looking at the distribution in excess of E&P and the stock basis. So depending on where the allocation ends, if the E&P is up to the amount of current year E&P, we'll treat it as a taxable dividend. If there's still anything remaining, then it will be allocated to the accumulated E&P. It will be treated as a taxable dividend. And if the distribution exceeds both current year E&P and accumulated E&P, then the remaining distribution will be compared against the stock basis, and any distribution is up to the amount of basis will be tax-free, because this portion will be represented represent the return basis portion. The finally, any distribution exceed the basis will be treated as a capital gain, the taxable capital gain. So this really is kind of like a tiered approach. When you think about the distribution, so you're really comparing all the benchmark and figure out the lesser of the distribution versus the benchmark, and to figure out you know is a dividend or return of basis or capital gain. So let's run through a quick example. I think there's something it's probably easy to see in example. This probably thing that will start making sense. So let's run through a quick example here. Let's say this corporation make a cash distribution of 250,000 on December 31st for a particular year. The shareholders basis in the stock before the distribution is pretty high, it's 1 million, right? So I'm going to change this number up, just make it just like a normal base scenario. So let's say I have 500,000 current year E&P and 500,000 prior year accumulated E&P. So this is accumulated E&P from prior year, right? So this is the two layers. And in this case, I have positive E&P current year, and I have a positive accumulated E&P from all prior years. So in this case, once we plug in the numbers, you will see the characterization of the distribution for shareholder will kind of run through the calculation by step 1A, 1B, and 2 and 3. So you can check the formulas and see how this work, right? How this work. So in this case, the first step you can make your own notes or write down your understanding of this part. This is really what they're doing is they're comparing the 250,000 against the current year E&P and see which one is smaller, right? So basically any distribution out of the E&P. So basically saying the 250,000 is less than the 500,000, then the 100% of the distribution will be treated as paid out of a current year positive E&P, right? So that's why it's the 250,000. Then after I did the first step allocation, of course, there's nothing left because, the 250,000 represents the full amount of distribution. So, then you do not have to go through step 1B or 2 or 3, right? Then, nothing is need be done down below. And the stock basis, you have not even get to the step, therefore the stock basis will be the same. And the distribution will reduce the E&P pool because the dividend is treated as paid out of a current year. E&P, kind of like a regular dividend payment, will reduce the retained earnings. And let's say I change this number a little bit, make this a little bit higher. I'm going to make this number as 1.5 million. In this case, I'm going to change the number and see what happens. So in this case, you can see my calculation automatically pickups and automatic updates, and we're still doing the similar steps, right? I have 1.5 million cash distribution, and then first I'm going to compare this distribution against the current year E&P. The smaller of the two will go to the current year, the first step 1A. And then after I do this allocation, I still have 1 million to allocate. So I'm going to go to the next step. So this formula, this long formula here, is basically doing the logic, right? Doing the logic and basically compare the remaining distribution after the allocation done at step 1A against the cumulative E&P and figure out which one is smaller. Then leave whatever smaller amount here, right? In this case, the 1 million versus the accumulated E&P, that's 500. The smaller is 500,000, right? Then after I allocate the step 1A and step 1B, I still have some left over because I have 1.5 million. then the rest of the 500,000 will be used to compare against the shareholders basis. So in this case, again, I'm looking at shareholders basis versus my remaining amount of distribution. In this case, this smaller of the two is the remaining amount of distribution. That's 500,000. So that's the return on capital. There's nothing will be exceeding the return on capital. Then there's nothing will be allocated to the capital gain, right? But if I change this number to a much larger number, let's make this 3.5 million to see how this impact. We'll see step 1A still the same, step 1B is the same. Again, is equal to the current year E&P. Accumulated E&P return capital is 1 million, basically whatever the basis. That anything remaining is the 1.5 million, the capital gain. So it's again the tiered approach, right? So at the end of the day, the total distribution is still the 3.5 million, and the only difference is there's this 3.5 million is allocated to step 1A first, then step 1B second, and step 2 the third, and step 3 the fourth. Okay, so we're to kind of fill in each bucket until it's full, then I move on to the next bucket. So that's the kind of the gist of the tax treatment of the corporate cash distribution, the general rules. And of course, things can get a little bit more complicated, right? If you're dealing with middle of the year distribution, or in some cases, if there's a negative current year E&P, but somehow you have prior year positive accumulated E&P, then things can getting a little bit tricky, right? So you can read the rules, and let me just make this change here. See, how this works, right? So you kind of try to figure out what it is, or if I have a negative current year E&P, what it looks like, and see how that how everything comes through. So again, this is try to simulate what's happening here in the in the discussion as far as how the cash distribution is characterized. So if you unhide this is basically what what's this is saying here. So what's going to happen in this case, right? So you can run through the simulation and see how this calculation is done. But do not get too stressed out about so much details. But generally speaking, when you're dealing with the distribution, you more than likely you're looking at a positive current year earning and positive uh, prior year earnings. So those unusual scenarios could be very unusual, but it's just good to know when you read, how those implications could be different. One of the things that you do want to kind of consider is in the special rules, is if there's a negative current year P, and you do want to combine this the current year negative E&P with the prior year accumulated E&P if the current year E&P is negative. So that's some special rules considered in this reallocation. But again, use this template, kind of run through some of the scenarios and see what it looks like, and get a feel, how the cash distribution allocation works. Okay, so this is really kind of the core knowledge. We want to make sure we understand. There will be homework regarding this calculation here. So if you come back to the Excel worksheet, you will see the first one will be a homework you will see in chapter 18 and 37. This is example basically showing there's a current year E&P, and but there is accumulated deficit. That means a prior year accumulated negative E&P from prior year. And when in this case I have the cash distribution and also the shareholder basis, the question now is, again, how the distribution is treated, what's the tax basis, and what's accumulated E&P, all that stuff. So you can definitely spend some time and reading the rules, understand how this is calculated along with this template here. And the idea is for you is to to review the rules, right? Review the rules and come up with a calculation. And finally, you want to think a little bit deeper, say, okay, in this case, this is what happened, why this happened this way. Or if I want to streamline the calculation, how can I do this, right? So those kind of the reflection you want to think through more, rather than just say, okay, I'm going to finish this calculation and move on. Okay. So the next, we're getting into the property distribution. The property distribution is a little bit more complicated. The property distribution is still, from a shareholder's perspective, they still kind of have to run through the rules, right? So those rules still apply because, property is still, a value distribution, right? But the point in this case, because there's a property involved, the first thing they have, whenever there's a property involved, there's things always getting more complicated, right? Why? Is because the property first, you have to figure out what's the fair market value of the property, right? Second, is there any liability attached to the property? Because when you transfer the property from one person to another person, a lot of times the liability attached to the property is transferred at the same time. So if that's the case, you have to consider, everything, goes along with this property and figure out what is the true amount of the distribution in dollars. So that's the first step. The second is because, whenever the corporation is distribute the property to the shareholder as a dividend, and because it's property distribution, there's a portion they have recognized the gain. There's a gain. If there's a gain, they have to recognize the gain, but losses on the distribution of appreciated property. Again, this is something we're tied into kind of the built-in gain property, is because initially when the shareholder contribute the property to the corporation, it's a tax-free transaction. This is something we're going to cover in chapter 19. But now they're saying the corporation, when they get it, then they're distribute the property back to the shareholders, and they're going to recognize the gain. So how much gain they recognize? The gain is recognized to the extent of fair market value in excess of a tax basis in the property. And again, recognized also increases corporate earning and profits. This is kind of like a nested calculation happening here when there's a property distribution. So we'll have some homework problems kind of help you walk through one example here, uh, to kind of help you figure out, how the property distribution works. Stock distribution is, some generally speaking, is a tax-free transaction, and except for non-pro rata stock distributions, just something for you for your information for you to read. And once we're on this point, I just want to highlight, do not, for the textbook reading, you want to first have a general understanding where things are at, which are the key, which one are just additional information, or, something information we probably will not get to, just for your information only. You want to spend more time reading some kind of the basics, those are the foundations, and before truly understand this part, before you get to the advanced topics. Because in other words, not all the sections are treated equally, right? Especially for assessment purposes, really we're going to focus on the core, the basics. We're not going to get into the stock redemption, the partial liquidation, all of this stuff, which is truly a more advanced topic for master level course. And, at our level, at undergraduate level, we're just try to understand what's going on. What are the basic concepts regarding this transaction. We really do not need to dive into in too much detail on those topics. Okay, the stock redemption, same thing, just to kind of rate it and understand what it's about, and in what instances stock redemption treated as exchange, and in what instances it treated as a dividend. So those are just for information only. I really do not need to dive into this too much. Okay, finally, I just want to have a quick overview of the homework. The first homework is the distribution, cash distribution, characterization. Again, this is a key in the CPA exam. This very commonly covered topic for simulation. And the second question is a quick and dirty calculation on E&P adjustments. So again, there's a few things listed here. This is similar to the book tax differences. The only difference is we're starting with taxable income. Then you're just, adding on the E&P adjustment to derive the current year E&P. It's pretty straightforward. And the final question is the property distribution, the treatment of property distribution, and how this could impact the E&P, and how this could impact the shareholders as well as the corporation. So to sum up, the key for chapter 8 is related to the how to characterize the distribution um, distribution from the corporation to shareholders. What's the tax impact for the corporation as well as the shareholders? The focus is on cash distribution and the property distribution. Okay, that's all I have for today, and thank you for listening, and you have a great day.